If you're a homeowner, this is probably a question that's crossed your mind a time or two. Should you refinance your mortgage? Look, it seems super complicated, but it really doesn't have to be. So let's break it all down and give you a clear way to figure this out for yourself. So let's just start right here. Is your current mortgage secretly bleeding your bank account dry? I mean, with interest rates constantly changing, that great rate you locked in a few years ago might actually be costing you a ton of money today. Refinancing could be the thing that plugs that leak. And we're not talking about just a few bucks here and there. The average monthly savings for homeowners who refinance is a pretty solid $189. Just think about that. What could you do with an extra couple $1,000s a year? That's a real, tangible benefit we're talking about. All right, so where do you even start with all this? Before we get into the nitty-gritty, there's this fantastic, super simple rule of thumb that can give you a quick yes or no answer in like 10 seconds flat. Seriously. Here's the magic number you need to remember, 0.75%. The general rule is that refinancing really starts to make financial sense when you can lower your current interest rate by at least 0.75%. Think of it as your first super quick filter to see if this is even worth your time. And check out this table, it makes the rule really easy to see. See that top row? If you're at a 7.25% rate and you can get 6.50%, that's a no-brainer. That's a definite yes. But look down at that last row. If you're starting at 6.50%, the recommendation becomes a maybe. Why? Because the savings are getting smaller, and you really have to ask if it's enough to cover all the fees of refinancing. It's your first little reality check. Okay, so if that rule of thumb got you thinking, maybe, then it's time to roll up our sleeves. Because it's not just about the interest rate. We've got a 5-point checklist to make sure this is actually the right move for you and your specific situation. So here they are. First, we'll talk about how long you're actually planning to live in your house. Then, we'll look at your credit score. That's a big one. After that, we'll get into the specifics of your loan, figure out what you're really trying to do here, and yeah, we'll even try to peek into the future to see where rates might be headed. First up, and you could argue this is the most important factor of all, your timeline. Refinancing isn't free. You've got closing costs, and those can run anywhere from 2 to 5% of your loan amount. That's a big chunk of change. So you have to be absolutely sure you're going to stay put long enough for those monthly savings to pay you back, and then some. So what you need to figure out is your break-even point. It sounds all technical, but it's really not. You literally just take your total closing costs and divide them by how much you'll save each month. That number, that's how many months it'll take before you're actually making money. And hey, quick pro tip, if you see a no-cost refinance advertised, be wary. The costs are in there, trust me, they're just baked into a higher interest rate. So for example, let's say your break-even point is 42 months. That's 3.5 years. This is why that timeline is so important. If you think you might sell your house in the next 2 years, refinancing is a total waste of money. You'd end up moving before you even got your closing costs back, let alone saved a single penny. Okay, let's talk about factor number 2, your credit score. You know this one. That little 3-digit number is basically your financial report card for lenders. And the bottom line is simple. A better score gets you a better rate. End of story. So what's the magic number here? Well, to get those absolute best rock bottom rates, you're really shooting for a score of 740 or higher. And think about it. If your score has jumped up since you first got your mortgage, that is a massive, massive reason to look into refinancing right now. And this chart just says it all, right? That jump from a good to an excellent credit score isn't just about bragging rights. Look at that gap. That gap is money. It represents a much lower interest rate, which literally adds up to tens of thousands of dollars in savings over the entire life of your loan. It's a huge deal. Next up, number 3 on our checklist, the loan term. This is where you might think about making a big switch, like going from a 30-year mortgage down to a 15-year. Now, you can save an absolutely staggering amount of money on interest this way. But, and this is a big but, get ready for your monthly payment to go up. Even with a lower rate, you're paying it off way faster, so that monthly bill is going to be bigger. All right, factor 4 is all about your why. What are you trying to accomplish here? There are really 2 main options. The rate and term refinance is the simple one. You're just trading your old loan for a new one to get a better rate. Easy. But the cash out refi is a totally different beast. That's when you borrow more than you owe to get cash out of your home's equity. That means a bigger loan and, you guessed it, usually a higher interest rate. You gotta know which game you're playing. And last but not least, we've got factor 5, trying to time the market. And let's be honest, this is the hardest part. Nobody, and I mean nobody, has a crystal ball that can perfectly predict where interest rates are going. But we can look at what the experts are saying to get a sense of the trend. So, as you can see here, rates right now are sitting around, let's call it 6.45%. But some forecasts are predicting they could drop closer to 6% by the middle of next year. And this puts you in a classic tough spot, right? Do you lock in a pretty good rate today, or do you hold out and gamble that you might get a great rate a few months from now? There's no easy answer to that one. Okay, we've talked a lot about the green lights for refinancing, but it is just as important, maybe even more important, to know the red flags. So let's run through the big warning signs that should make you just stop and really think this through. First off, if you're planning to move in the next couple of years, just forget it. You will almost certainly not hit that break-even point. Second, if the rate drop is tiny, like less than 0.5%, the savings probably won't be worth the hassle and the fees. Third, if your credit score has gone down recently, you're just not going to get the kind of offer that makes this worthwhile. And finally, if you're way deep in your loan, like 20 years into a 30-year mortgage, resetting that clock is usually a bad move. So there you have it. From that simple 0.75% rule to the deep dive with our 5-point checklist, and now the critical warning signs to watch out for, you really have the whole toolkit now to look at your own mortgage, your own finances, and make a smart call. The only question left is, what's the right move for you?